Hi, everybody. I'm Michael Wagner, one of the co founders here at Omnia Family Wealth. What we're doing is a multi part series of our 2021 investment outlook. And I'm joined today by Alon Ozer, the Chief Investment Officer here at Omnia Family Wealth. Hey, Alon.
Hey, Michael.
Good to see you.
You too.
So, we're going to talk today about inflation. And you've probably been hearing a lot more about inflation recently than you had been in the last several years. So, Alon, let's get right into it. What's inflation?
It's a very good question, but not a simple answer. So, inflation basically could be rising costs of merchandise that you're buying, services that you're consuming, or on the other hand, the value of your currency. So it can be in both ways. What's important to know about inflation is the inflation is very different between each individual and between each company. And the first thing that I'm going to say before I define what that is that the CPI, okay, the consumer price index that you hear about a lot, and especially the core CPI, is actually something we don't really use because it's very limited. The calculation is biased, especially in recent years when a lot of the consumption is being done through the internet, so prices are usually lower on the internet, but the service that they do for the CPI is with brick and mortar companies. So it's very biased. Also, the other thing is important to remember that almost any administration that came made a change to the CPI calculation, and it's never on the higher side, right? It's always on the lower side. So that's important to remember. When we talk about the different inflation between people is based on your consumption, where you are in your life cycle. So if, for example, you have kids that are going to school, for example, college or something like that, tuition is a big part of your expense. So that's going to be an inflation for you rising in tuition. If you have high medical costs and this is something that you need or you need for the family, that is something that's going to affect your inflation. If you're a young couple that's looking to buy an apartment, then rising cost of rents and assets is gonna be your inflation. So for each one, inflation affects him very, very differently. The other thing is that when we say that CPI, we don't really use it is because you can have CPI that is very low, like we've seen in the last several many years actually. But at the same time, other areas in the economy see significant appreciation of prices of services, prices of commodities, prices of different products. But this is something that's not going to go into the CPI. So it's not really useful for us to measure that. And they say there is inflation, there's no inflation, while in reality, there are prices increasing in different areas of the economy.
So, who does use CPI?
CPI is used by a lot of institutions if it's to adjust payments, benefits, things like that. It's mostly government agencies that use the CPI. In contracts, you would have a CPI, but it's not something that you would want to use when you invest money because it's really not a good understatement, a good measure of inflation.
So, there's an irony there because the Fed uses CPI when it measures inflation. And there's the old joke that, like, the Fed chairman doesn't buy eggs or drive a car that uses gasoline, right? So,
Right.
they ignore all of this. It can be more volatile in the data. But when the Fed is targeting, when they say that they're targeting 1.5%, 2% inflation, it's not the same 1.5% or 2% inflation that we may feel at the grocery store, the gas pump, or anything like that. It's a very academic sense of inflation.
Correct. That's 100%, and that's another good reason why we don't really use that as a measure. When we are concerned about inflation, and that's something we can go into it later, then we're not going to look at CPI or, for example, TIPS, which are inflation protected treasuries, to protect our portfolios. This is something that's not gonna really do anything. Even CPIs goes dramatically by 3%. How much your tips are gonna do? On the other hand, if you're going to look at something like commodities, they're going to appreciate significantly if you really have that type of inflation. So it's important to define that before you get into actual strategies in portfolios.
Is there such thing as a healthy level of inflation?
Yes, there is. Inflation, when inflation comes from growth in the economy, it's something healthy. It's something that is actually welcome. We can control it with interest rates. So we used to be able to control it with interest rates. And this is something that's part of the business cycle. It's something natural, and we used to see it all the time. So a little bit of inflation is it's actually a good thing. The inflation that the Fed is targeting right now, trying to drive inflation, is actually not a good thing. And this is something that's very important to understand. First of all, because, and let's remember, we are not the generation who experienced inflation, right? So we don't really know what inflation is and how it affects a lot of the assets. And that's why it's so important to go back to the literature and really read about what happened during inflation in different countries, in different areas of the world, in different assets. That's how we can really understand what's going to happen. One thing you would learn from this literature is that once inflation is starting to pick up, it's very hard to stop it, right? And one of the things that we always talk about is that the equity markets, for example, cannot sustain high interest rates. And we saw that every time the 10-year goes higher, we see that the equity markets are telling us, well, just be careful, there's a problem there. What we see right now is, and what's going to happen is that if you have inflation, how are you going to stop it? You're going to raise interest rates? You're going to destroy the equity market. And this is something that I think they're playing with fire when doing that. The question is, that they're going to be successful or not? That's a different conversation. We don't think you're going to see CPI inflation because the amount of debt that we have, each dollar that goes into the system contributes less and less as you pay more for debt servicing. So we don't think you're going to see that. But you can see a lot of other effects: inflation in asset prices, inflation in commodities, inflation in other areas that could affect your portfolio. So that's something important.
And that inflation is really part of the Fed's dual mandate, right? It's price stability, aka inflation, and employment, right? And it is a dual mandate. It's not a triple mandate. So traditionally, the Fed hasn't cared much about what's going on in the stock market, right? And that's different today than it was, I think, in the past.
Correct. It's very different. It's very different, and it's unfortunate but that's part of the cycle. This is something that we talk about all the time, about the overall picture and the debt cycle and how it affects different sectors in the market, the equity market, the fixed income market. And yes, at this point, it's very difficult for the Fed to raise interest rates. It's very difficult for them would be very difficult to control inflation, especially if inflation doesn't come from growth in the U.S. And this is something that goes back to the sources of inflation, because you can have an inflation that is generated by growth, local growth in your economy, which is something that we would welcome, of course. And you can have inflation that we're importing from somewhere else. So, for example, if you have, and this is something that we see and we think is going to happen, and we implement that in portfolios. If we see significant growth in emerging markets, for example, we're going to see higher commodities, we're going to see higher prices of different services that you buy. And actually, our clients are a great source of information because they own businesses and they tell us about the price increases that they see coming from emerging markets. So when you import that inflation, how are you going to control it? With interest rate, you can't really control it. That's something that's a problem.
So that mechanism there is that, for example, if we're manufacturing goods overseas in a low-cost production country, right, as their standard of living increases, right, due to all of that business that they're getting being a manufacturer, their wages go up, which means that the prices for our goods go up, and through that mechanism, we're importing some of their inflation.
Exactly.
Right? And that's less desirable than, let's call it, homegrown economic expansion inflation.
Absolutely. And this is a problem because really you can't control it. This is something that's just gonna drive inflation based on what's happening in other areas of the world, but we are so dependent on buying from them and importing from them, that we're going to import the inflation. And this is something that we're actually seeing with commodities right now.
So when I think of inflation, I think of, yes, the U.S. in the 70s, we were importing, I think, through commodity prices, a lot of inflation. But then you can also look internationally, right? I think Venezuela is a good example of really hyperinflation.
Right.
And do you see us on a path towards something like that? Is that a concern for us in the United States? How do we walk that fine line between healthy inflation and hyperinflation?
Right. So hyperinflation is not something that hyperinflation is more of a social phenomenon. This is something that happens when people, just like you said in Venezuela, they lose faith in their currency. So at that point, they would buy anything except holding their own currency. So they would buy this cup of coffee, or they'll buy something else just not to have the currency. That's why you don't see anything on the shelves in stores in Venezuela. This is the hyperinflation. But when hyperinflation happens, there's usually the beginning of the end of the currency. So for the U.S. to get to that point, I think we're very far from that, especially because so much consumption in the world is done with the US dollar. So I don't think we're going to get there. Can we have high inflation? Yes, that's something that we can see. We can see it through commodities. We can see it through other, like we said, emerging markets. Hyperinflation is really something, and again, if we go into the literature, and there are a lot of good books that talk about inflation in different countries. It's the destruction of the society. It's really something that we have a lot of bad consequences.
So you can get into a hyperinflationary environment when it goes beyond a monetary phenomenon, becomes more of like a social and psychological issue for a country. Really interesting stuff. How does this apply to the work that we do every day in building portfolios? So as we know, the Fed is basically saying that they're encouraging inflation. They have an inflation target. They're even willing to go beyond that target for a limited amount of time. So they're kind of telling us what direction they'd like to head in. What impact does that have on, like I said, what we do every day, building portfolios, thinking about risks and opportunities in the market?
Right. So it's a very important point, and what you mentioned about the Fed and the administration, I think that investors need to understand that at this point in the cycle and the amount of deficit that we have, the best solution for us to stimulus growth is using all these packages. If it's the infrastructure, if it's the PPPs that they help to they generate to help businesses, that's the way to do that. The problem is you need to print money for that, because you're not going to raise all of it from taxes. You have a lot. They're even talking about erasing student debt, which is something that's going to put thousands of dollars in people's pocket instantly. So that's something else that they're talking
Should
about.
be inflationary,
Which
money
is going to
people's
be
pockets.
exactly that's what they're trying to do. The problem is that when you do that, you basically targeting the dollar. You cannot just stimulus, because the Fed has to buy the treasuries, have to buy the debt, right? And monetize the debt. They're targeting the dollar, which could also be inflationary.
Which is supply and demand, right? As we supply more and more dollars,
Exactly.
becomes worth less and less.
Exactly. And somebody has to absorb it.
Sure.
So interest rate doesn't start jumping and the currency doesn't fall. So that's one thing to remember, that they're targeting basically the dollar, because that's the only solution long term. So that's one thing. Now, when you look at portfolios, if you are an American that uses dollars, consume with dollars, you want to protect your purchasing power, right? So that's one thing that you want to do. So whether it's a commodities to have in the portfolio, or is it emerging market equities that are going to appreciate when the growth is in those markets, that's something that you want to have in the portfolio. Now, how much, which type of commodities, that depends on some other factors, but in general, this is something that you want to have. So if you hear that there is inflation, people wants to protect their portfolio against inflation, and they use tips, like we said, it's basically useless. It's not going to do anything. it's going to appreciate based on the CPI, but in a minute the dollar is going to fall more than the CPI, it's not really going to help you a lot.
Sure.
Commodities, emerging market equities, these are usually the best way to the best ways to protect your portfolio against significant inflation, real inflation.
Thank you. So what is it that would be disadvantaged by inflation, right? So where should we be concerned in portfolios? What can potentially underperform in an inflationary environment?
A lot can go wrong, and that's the problem, and this is part of the cycle that we're in. Because in the cycle, where we are in the cycle, different assets behave differently, and at this point in the cycle, the biggest concern that we have is interest rate. Right? So if you do have inflation and the Fed decides to cap inflation by raising interest rates, they're going to destroy the equity market. At the same time, they're going to destroy the fixed income market. So they're kind of stuck between a rock and a hard place. But that's part of the cycle. That's how it's been for years. Once interest rate hits the zero bound, that's how it is. It's very hard to get out of this situation. That's why you have to have the ability to really invest abroad in markets that have different cycles, in markets that behave differently than our own market. You cannot have all your portfolio in the US concentrated here in the US. And it's something that's getting more and more and more important. So inflation is a big problem.
And I think that ties into so much of what we've been talking about for really a long time, that you need to be well diversified, that it's not enough to have that simple 2-asset stock and bond portfolio anymore. You really need a third or even a fourth leg to your stool to have stability in your portfolio as we face all of these inflation and interest rate challenges in the markets. There are certainly risks and opportunities, and so much of what we do is knowing the risks that are out there and making sure we're being fairly compensated for them. So I think this was a great conversation on inflation and some of the risks it posed to you. Alon, I want to thank you as always for your time and
My
your
pleasure.
insight and your wisdom. And I want to thank you, the viewer, for spending some of your time with us today. As always, please consider your source, and we'll see you next time. Thank you so much.
Thank you.